Hello Proponomics people, and welcome to the Sunday Supplement Summary version on Monday the 29th of January 2024. So yesterday's article was titled Bullish in a China Shop because I felt that I probably hadn't been clear enough about quite how bullish I'm feeling about the medium to long term future of the UK property market at the moment. Now that doesn't mean that prices are going to go up immediately or whatever, but I do strongly feel like we're in a period whereby you'll look back on this period and think, blimey, I wish I bought more houses during that time, as if they keep going up, etc., etc. Now, what's the real drivers behind a lot of that? Well, inflation is. So in real terms, how much things have actually gone up, including wages, apart from anything else, which are outpacing inflation at the moment and are basically guaranteed to do that at least for the next few months as we go into an election year and as we go into an environment where we've already seen a near 10% increase in minimum wage, which will have to feed through into a lot of other wages, even if there are some job cuts happening, some recruitment freezes happening at the moment, and the likes. So cautiously optimistic is what Bard's AI has told me today. I'm feeling in that article, and that feels about right, really, apart from anything else. I discussed the PMI flashes, so the Purchasing Managers Indices, and how they're moving ahead of consensus. Services expanding, manufacturing still contracting, but not as fast as everybody thought. But the composite, of course, services are just so much more bigger part of the economy than manufacturing is. So the consensus is forward, and not just forward at a reasonable rate. We're sort of 5% ahead of the centre line. So pretty positive PMI readings. And I like those readings because they're real time and I think they give us quite a lot of information. And then I talked about some optimism indices, which is not something I've touched upon in the supplement before. So from a business perspective, the CBI, Confederation of British Industry, and from a consumer perspective, GfK, the Growth for Knowledge. And both of those are improving. Both of those are still negative. However, business only slightly negative. Consumers still a reading of -19, where 0 would be neutral. But that -19 is the best print in a couple of years. So that's just where we're at the moment, apart from anything else. On the flip side, the retail sector is still falling, had a bit of a resurgence during COVID because there was nothing else to do, and is now paying the price for all of that as that continues to tail off, apart from anything else. So retail still struggling. But of course, rising cost of living has affected people's ability to pay. I think also people have maybe changed some of their spending habits, and there's still, remember, nearly twice the amount of saving going on that there was pre-pandemic. So that's money that's being saved, not spent, which maybe means people are still preparing. They're still a bit scared. They're still preparing for the worst. We're not where we were in 2019. We are dealing at the moment with rising swap rates and bond rates again in terms of yields, but I'm not surprised about that because this sort of 3.25% place we got to in the 5-year before Christmas was frankly just ridiculous. Only survived in a very thinly traded market, and the real range 3.5 to 4. I've expanded that maybe to 3.25 to 4.25, but that's the range we should be trading in. And you've got to remember the volatility has come right back down, although there's been obviously news overnight of a drone strike killing 3 US soldiers. So that will undoubtedly unnerve the markets when we open today. However, volatility compared to volatility when, for example, the banking crisis in the US was only March last year, and a couple of banks going pop who were in outlier positions really, or dependent on crypto or whatever. But of course there could have been contagion in the system. That contagion could have been more US banks. It could have been also European banks, UK banks. So everyone was on relatively high alert. That seems like a long time ago now, and obviously that didn't spread through the system and was well looked after in the end, realistically. So my property price number for the next 5 years, I've said 25% worth of capital growth, and you can certainly hold me to account for that. And if I had to bet over or under, I'd probably bet over, because I tend to try and be cautiously optimistic with those predictions, but not overshoot or give the very best possible picture. So 25% plus is where I put my current 5-year forecast. Doesn't mean it's going to happen in the next 6 months. In fact, it might be quite slow to get started, but let's see. So that really covers the supplement from yesterday. The other thing that I did, apart from else, because I really just couldn't resist, is I just had to tuck into the 2 bloody ridiculous policies that were outlined by the 2 major political parties in the UK last week. So that was the 99% mortgage, which was chosen for its gimmickry because the 100% mortgage has already been done and has a lot of negative connotations attached to it, but was recently re-released on the 9th of May 2023 by the Skipton Building Society. The point being, there's nothing wrong with the 100% mortgage as long as it's underwritten correctly. And of course, the problem in 2007 and before is that they just weren't underwritten correctly. They were giving away, pumping money out the door, cheap money that was getting more expensive, that was always going to put people in a terrible position and was fueling the housing market growing to a ridiculous level. Unsustainable, classic bubble. And I think by now we all know what happened. So to be even, I also had a go at the red corner, the Labour Party. So their policy was 25-year fixes. And I genuinely can't imagine much more stupid than waiting for a 20-year high in bond yields, looking at a yield curve where interest rates are high for short-term debt and high for debt longer than 10 years and a bit lower in that middle band of 5 to 10. They're still not cheap at the moment, around the 3.8 for the gilt yield. So add a couple of percent on that for your buy-to-let mortgages, generally speaking. But why would you go to the more expensive part of the curve? Why release the 25-year fix now? 3 or 4 years ago, it would have been a good idea. When we're in 2021, it would have been a fantastic idea. When interest rates were nearly zero, it would have been amazing. So would Skipton's 100% mortgage or the Tories' 99% mortgage. But no, we're waiting till it's as high as it's been for 20 years, and then we're going to fix debt for 25 years. It's just inherently stupid. And it's already around as well, because Habito do 30 and 35-year fixes, and I believe they do 40-year fixes if people want them, which generally they don't, and they're certainly not going to want them at this time. They don't know about flexibility. I don't think enough is done to help people understand porting. I think you need something more like the current account switching service. But I think, as I've said in the article, it's really, really easy for me to just lip off about what a terrible job from a policy perspective both the main parties are doing. So instead of just doing that, I decided I should come up with my own policy solution. And my policy solution is to offer an equity release style solution, government backed, so that the government can actually make some money out of it. So equity release charges that can sit behind a first charge up to a reasonable level of LTV, right? They don't need servicing every month. And this is for Bank of Mum and Dad. So it's Bank of Mum and Dad doesn't just become about equity release alone, doesn't just become about unencumbered assets. Perhaps you're sitting with a 20% mortgage because you've paid most of it off, and you can help out your son, daughter, nephew, niece, family, friend, whatever it is. That needs to be facilitated in a better but similar Fannie Mae, Freddie Mac kind of way that they do in the States. So the governmental charge can sit behind. It doesn't need servicing. It can be based on the actuarial expected lifespan of the parties that own that property. And it can also be available before the age of 55, which is where equity release kicks in. And I also think the government can take a few more risks on the LTV. So at 55, you wouldn't normally see more than about 30% loan to value. That is so insanely cautious. If you are betting on a long-term functioning property market where, guess what, prices will move up, but let's just say they move up at RPI. In fact, if you look at the last 20 years, that's exactly what's happened. Prices have basically kept pace with RPI. What we don't want is boom and bust, apart from anything else. But if we can theorise where RPI will probably be over the next 20 or 30 years, probably around the 3% mark on average, although governmentally they might not want to say that, but RPI, remember, is not how we measure inflation anymore because we've got CPI. But if we took RPI and said, look, it's going to be about 3%, the government could be in a great position where they could release quite literally trillions of pounds against the 10 trillion pounds of equity that's in the UK housing market for people to carry on succession planning and help people onto the ladder, all with lower loan to value mortgages, which again the government could get involved, or the regulators could get involved by saying, look, when the mortgage is below 60% LTV or whatever, there needs to be a rate that's distinctly different from 70, 75, 90, whatever. Although the government could subsidise the higher risk with some of the help to buy style situations that they've already used. So that's a really whistle-stop tour of my policy idea there, but I think you'll find it's considerably better than either of the other two political parties have released. Now, unfortunately, that's not a very high benchmark, but the point is this stuff can be done if you know your market, if you understand markets and economics and things like that. It needs some thought to actually fix the problems rather than just try and win some votes. And I'd love to see some of that in the upcoming election. Not that we will, unfortunately. But there we go. That's me off my political soapbox for the week. Hope you enjoyed this roundup, and I'll see you again tomorrow.